I remember when I was first in the States in the 1980s, early 80s, and I remember mortgage rates at 16%.
Yes.
You got 12% on deposit at the bank. It was a different era altogether. And I'm not saying that's where we're headed, but with the tension that people are sensing, certainly in the market, about inflation and the anticipation of some fairly steep interest rate hikes, it's clearly anything, 200 basis points and up, really, even for just this, I mean, it's significant. In the early 80s, it would mean nothing, right? It's like a blip. Yeah. But we're talking about doubling rates at the moment. Right. Are you seeing from your surveys and even from anecdotally or from your research, are you sending any indications of how consumers are reacting in terms of their borrowing or their finances in general?
Absolutely. Whether it's a recent survey that we've done of consumers or essentially individuals, or anecdotally, it's obviously having an impact, and it weighs most heavily on the consumer psyche. So one thing I've been thinking about in recent days is with gasoline prices as high as they are, and that tends to be something that people complain about first when that occurs, is like
gasoline.
Yeah. The price of gas.
I'm actually, as you know, I'm in LA. I've seen $7 gas.
Oh, I know. Yeah, right in Beverly Hills there.
It's crazy. Yeah. It's $7.
I didn't know you could have full service gasoline stations, but I know they still exist not too far from where you are.
Right.
But, we're talking about buying something that nobody really wants to have to buy. And when they do purchase it, it ends up essentially going up in the equivalent or the actual going up in smoke. And so coming into this, if you want to call it a current crisis, the good news is that American households and their balance sheets have been in the best shape that they've been in quite some time, in part because of all the things that were done to keep them whole, whether it's something like, mortgage forbearance or the child tax credit that expired as of the end of last year. And so the Americans' savings have been, I would say, elevated. But we could quickly see that being drawn down because you're having to pay so much for so many different things. And obviously those at the lower end of the wage and wealth spectrums are very much at risk, but those in the middle class are very much at risk as well. So it's going to be key to watch things like actual spending, retail sales in the coming months. And I would expect that at least for the next 2 months, measures of inflation are truly going to be stunning, to say the least.
Do you really? And when you think inflation's we're going to see it spike even further?
Yeah, I mean, we have to, because the consumer price index was most recently put at a year-over-year increase of 7.9%, which was essentially for the month of February. And since then, we've only seen these prices go higher. So that doesn't mean that has to be sustained over a long period of time, but it's making, if it is not sustained, if we actually have some pullback in inflation or retracement of those numbers, it's going to make for quite the dramatic closing act.